All right, I want to look at two of these reports today. I know you were kind of going back to yesterday. By the way, you didn't want to overstate about Citi? That's a surprise. You like to talk about Citi.
Oh, I forgot that's our running joke. I'm sorry. I should remember that.
But we got to get to the numbers, because that's what people are here for. Morgan Stanley, when it came to investment banking, that was up 47% year over year. Also looking at Goldman, equities trading up 25%, investment banking also up 25%. And I think these reports, I would think, Malcolm, they led you to two of your first-time buys of Morgan Stanley and JPMorgan since Morgan Stanley reported today. Why don't we start there?
Yeah, so I've been championing those three names, calling them the big three for probably a year now, but I haven't actually had an opportunity to own any. And I think the president's proposal for a 10% cap on interest rate on credit cards gave me an artificial selling period to give me an opportunity to start buying shares. So any pullbacks we get going forward, I intend to keep buying there. I think that IPO activity is going to remain strong. We saw basically twice as many IPOs in 2025 as we did in 2024. There's some really big blockbuster ones that are slated to come this year. And the big three, Morgan Stanley, JPMorgan, and Goldman Sachs, basically participated on every single, or one of the three of those names, I should say, participated on every single blockbuster M&A transaction last year. And I anticipate that's going to continue this year. So as they continue to ring the register, those three banks specifically, I think, don't really, net interest margin isn't really the metric that matters as much for those three banks specifically. And so regardless of what interest rates do or how banks are positioned to profit from the declining interest rate environment, I think that those three are going to do very well, specifically because of all the M&A transactions, the IPO activity, all that's going to happen.
All right, walk me through this trade one time, because if the catalyst here was the pullback based on the idea of capping credit cards, well, one has the most exposure to credit cards, JPMorgan Chase. The other one has none. Of course, we know the president's going to be in Davos next week, and maybe surprising to some people, he's going to have a domestic-focused speech that he's going to make about affordability. We know that credit card caps might be part of it. We also know Jamie Dimon's going to be there. There's potential, at least, for there to be a lot more rhetoric about credit cards that could impact JPMorgan that hypothetically would kind of evade Morgan Stanley. So you worried about another pullback when it comes to JPMorgan coming up, knowing that we have this big event coming up in Davos?
Yeah, so my point is that the transaction revenue that gets generated anytime one of these companies advises or consults on an IPO far outweighs what they're going to earn on credit card interest.
Understood,
right?
but that was the entry point.
Right. And so it gave me an opportunity to buy shares of a company that had no business being down 5% on a headline that realistically probably won't come to fruition, at least not in the way it was proposed. 10% maybe turns into 20 or 25 or 30 where it probably is now. So I just think that it gave me an opportunity to be buying a company that I've had to come around to this Joe Terranova idea of buying high and hopefully selling higher, rather than these shares coming in to me, because we saw what Citi did last year, and it probably isn't going to create an entry point anywhere below where it is. All these are selling close to their 52-week highs right now. You just got to get comfortable buying high right now.
So opportunity, not an issue. Bill Baruch, coming over to you, your view of the financials right now. What we're hearing from these two companies today and seeing from them, as opposed to yesterday when it seemed like everybody was just looking for a reason to sell the bank.
Well, I think the reason to sell, I mean, that's pretty routine. You go get some excitement ahead of earnings. They're the first group to really report. And then there is a little bit of a wiggle always after these reports, no matter how good they are. Maybe one or two may avoid that wiggle. Goldman Sachs, Morgan Stanley could be those names here this time. Monster report from Goldman Sachs. It's exactly what we want to see. It's our largest name in the financial space, weight of about 3.25%, in our portfolios. And I may like the idea of it if it hasn't run so much of buying more Goldman Sachs. JPMorgan, it worries me a little bit. I do agree with you. I think the investment banking income is going to come around, but that underperformed estimates. It was what, 2.35 billion. They're looking for 2.55 billion. That was a surprise there. It's not the JPMorgan beat that we've become accustomed to, and so I'm taking it for a mulligan here. It has the credit card rate cap pull down. It had the post-earnings pull down. So I'm with you here. I think it can find support here, but I'm not looking to buy more JPMorgan. It's about 2.7 weight in our portfolio.